So there's this company I've been following, DIBS, 1stDibs.com. Pretty much they're an e-commerce company. They have an online marketplace. They sell luxury items such as high-end furniture for interior design. They have fine art, jewelry. Pretty much they're known for pushing the antiques business into the 21st century. So I posted this video last year when the stock was selling for around $4.22. I did a brief overview on why I thought this was an undervalued long-term investment. And so when we take a look at the graph now, you'd be up around 40%, which is pretty good, for less than a year. But I just wanted to make a longer form video to talk about why I think this stock is undervalued. It definitely isn't a growth company, but more of a value investment. We're just going to go a little bit more into detail of my thoughts of that YouTube short video. We're just going to put it more in a longer form video and see if any of my thoughts have changed in the past year. So let's go ahead and get started. So this is the latest transcript that they reported Q4 2023. I always like to start with quarterly data because it gives me the most recent data that the company reported, and I can compare it to the previous years to see how they've improved recently. These are a couple things we're going to talk about: earnings per share, total revenue, cash flow per share, and cash flow from operations. So earlier I was saying how this wasn't a growth company. As you can kind of see in total revenue, which we'll start off with, they're not really expanding their total revenue at all. They've had a slowdown in growth, and the total revenue has actually gone down year over year compared to the quarter before. When we take a look at the latest December quarter, it posted 20 million versus 23 million in 2022. That is a 9% decrease year over year. Pretty much 8 consecutive quarters of negative revenue growth. So when we go ahead and take a look at earnings per share, you could see earnings per share had a slight improvement the last 2 quarters of 2023. So the most recent, they posted negative 7 cents versus negative 18 cents back in December 2022. That is a 61% increase year over year. And the previous quarter before that, they had a 65% increase year over year. So the past 2 quarters, huge improvements in earnings per share. And I think the reason for this is if we go ahead and go to the earnings call transcript, when we go to the earnings transcript, there's a section that says, since they do have a strong balance sheet, there's a disconnect between market prices and our assessment of intrinsic value. What they did was they initiated a 20 million share repurchase program. And since mid-August of last year, pretty much when I posted that video, they've purchased 3.5 million, approximately 820,000 shares. The insiders do believe that the company is undervalued themselves, so they are using their money to repurchase a lot of their shares. So that's the reason why the past 2 quarters of last year, you could see that there's an improvement in earnings per share, even though there was no improvement in their total revenue. They are just buying back their shares, which will eventually boost their earnings per share. As you could see, it has already started happening. There is also an improvement in their cash flow. So when we take a look at cash flow per share, the latest reported was negative 6 cents. That is a 60% increase in cash flow per share. When we take a look at cash flow from operations, that is also a 61% increase. As you can see from 2022 to 2023, there is a trend to positive cash flows. They are trying to become cash flow positive in 2024 also. And I'm going to go over some of the facts why I think this is a value investment or even a turnaround play. One of the main things they talked about in the Q4 2023 earnings is that pretty much for the past 2 years, they haven't had any major growth. They've pretty much laid the groundwork for future success. They've pretty much taken the effort to optimize our operations, re-engineer our costs, and focus our efforts on a narrower set of priorities. Okay, so I wanted to switch gears real quick, and we're going to take a look at some of the balance sheet things. So some of the good things right off the bat, they have 139 million in cash, and they also have no long-term debt. With 130 million in cash, with a market cap of only 240 million, that to me right there already seems a little bit undervalued. We're going to do a quick little liquidation style sheet. This is just a sheet that I got from online, and pretty much I'm just going to copy and paste some of the things in the balance sheet. Basically, when a liquidation happens, what happens to a company is they're going to end up selling their assets, and some of those assets will be worth more than others. So some of these numbers are just going to be taken. So they have 139 million in cash. I have inputted that into the cash section, and accounts receivables, about 3.8 million in total receivables. They don't have any long-term debt investments. Net property, plant, and equipment, some of the real estate, 23 million, and I'm just going to put in 23 million. Some of the goodwill and other long-term assets. In total, they have 179 million in total assets. Moving on to the liabilities section, We just want to pick out some of the things that they might have to pay back during a liquidation sale before they could pay back their shareholders. Accounts payable, 3.6 million. We also have accrued expenses, which is going to be 9.3, and a couple of other numbers that they're asking for. One of the main ones is long-term debt. They're going to have to pay this back, but fortunately, they do not have any long-term debt. What this formula is going to do is give me a value. So they're going to take all the total assets, and they're going to subtract pretty much the liabilities that they have to pay back. And the value to our shareholders pretty much is going to equal 156 million market cap, and that's $4 per share. So it's pretty much their cash assets. That's one of their most valuable things. So pretty much this liquidation sheet is not too far off from what the market is pricing 1stDibs right now. They're pricing it at a $240 million valuation at $6. So now you got to remember that 1stDibs has a lot of intangibles. They have a lot of things that they created, sort of hard to put a value on. So a lot of the intangible things that they own, and it's going to be a little bit harder to value. They also have a strong brand. They have a strong brand, and they've been in business for more than 20 years. Some of their most durable competitive advantages are all intangibles. They've also provided people this whole marketplace, and they could all transact online. They've developed a huge supply base, the users and all the people posting all their items to sell, and they pretty much just provide this platform. And lastly, they've also cultivated this deep well of expert content. You could read about furniture, you could read about the new styles, read about real estate, and all of these things have a value to it. All these intangibles are also worth some money, and a lot of that isn't incorporated into the market cap or isn't incorporated into the value because it is harder to value. Anyways, I'm going to end it on that. 1stDibs, 215 million market cap right now. I do believe they're going to keep buying back their stock because it is pretty undervalued, so they're going to use some of that extra cash they have to buy back their own shares. Other than that, let me know what you guys think. Leave me a comment if you disagree or agree. We could talk about what everyone thinks. All right, see you in the next one.